For more than 30 years, we have never seen a time when the market and the people looked toward the future in such opposite directions. On the chart, the blue line, representing public confidence in the stock market, is soaring higher than ever before, even higher than during the euphoria of the year 2000, when people believed that prices could only go up. Meanwhile, the white line, which measures how ordinary people feel about their own economic future, has fallen to levels not seen since the global financial crisis. On one side stands the illusion of prosperity on Wall Street. On the other, the despair of those living in the real economy. Two worlds that once moved in parallel have now split apart, like two lines that will never meet again. This is not just a chart, it's a symptom of a disease that has quietly spread for decades. The widening gap between asset prices and real life. To understand why this is happening, we must go back to where everything began, to the real income of the working class. From the 1960s up until 2008, real personal income in America grew steadily at about 2.8% a year. That consistency created a powerful sense of expectation. People could plan for the future, buy homes, raise children, and prepare for retirement based on that growth trend. But after the crash of 2008, that line broke, and it never came back. If we take 1999 as a reference point, someone back then could reasonably expect their income to double over the next 2 decades. History had always supported that assumption, yet by the 2020s, that promise was never fulfilled. Real income stagnated while the cost of everything else, housing, healthcare, education, exploded beyond reach. And the irony is that at the very same time, stock prices were skyrocketing. Since 2010, the average real income in the U.S. has risen by only about 50%, while the S&P 500, the ultimate symbol of corporate power, has gained nearly 300%, even after adjusting for inflation. That means financial wealth has grown 6 times faster than real earnings. A society where people feel poor, yet are constantly told the market is booming, is a society that has been split in two. The reason lies in one deceptively simple word: savings. Since the 1980s, America's personal savings rate has collapsed from around 13% to just under 4%. At the same time, corporate profits have surged to record highs. Most of that profit hasn't flowed to workers. It's gone to shareholders. And shareholders, unlike wage earners, don't spend their income. They reinvest it into more stocks, more gold, more real estate, more crypto. When money keeps circulating within the same small group, asset prices inflate naturally. Homes, once priced at roughly 4 times the average annual income, now cost 7. Shelter, once a basic human need, has turned into a speculative asset. As housing costs rise and savings fall, workers lose the ability to accumulate wealth. They become spectators in an economy that was supposed to serve them. The result is a two-tier society, one that owns assets that grow richer by the day, and another that watches the cost of living climb faster than their paychecks. This divide shows up clearly in the data on hope. In the year 2000, 75% of Americans believed they could improve their standard of living. By 2010, that number fell to 50%. Today, it's around 25%. In just 25 years, national optimism has been cut to a third. This gap has brought America back to a very familiar point in history, the late 1920s. When wealth was concentrated, stock markets were euphoric, and people believed a new era had begun. Then came 1929. The crash erased those illusions overnight. In its aftermath, the U.S. government did something few today would dare to attempt. It raised corporate taxes to nearly 40%. It was painful. Profits shrank, unemployment rose. But it achieved something vital. It reversed the wealth concentration that had built up over decades. And out of that chaos emerged one of the most prosperous eras in American history, the golden age of the middle class. Since the 1980s, that process has been reversed again. Corporate tax rates have fallen to their lowest levels since the 1930s. Profits have soared, markets have exploded, but real wages have barely moved. Wealth inequality has widened back to levels not seen in a century. Once again, the corporate profit line climbs, while the household savings line sinks. When that happens, the system stops being capitalism. It becomes a machine designed to extract. Investors aren't wrong for seeking returns, but when an entire economy exists solely to preserve those returns, it reaches a breaking point. a place where every illusion of prosperity collapses under its own weight. The question now is no longer if a reset will come, it's where it will begin, and who will pay for it first. But every cycle reaches its limit. When profits outpace productivity, when asset prices grow faster than real value, and when debt expands faster than income, the system begins to consume itself. No one can predict the exact spark that will trigger the next collapse. Yet history leaves a pattern. When inequality peaks, when corporate taxes hit bottom, and when public trust evaporates, that's when the gears start to grind in reverse. Markets usually sense it before policymakers do. In 1929, the Dow Jones peaked nearly 2 years before corporate taxes began to rise. When profits become too large and too concentrated, policy eventually swings back, not out of morality, but out of necessity. And when that reversal begins, it is never gentle. What follows is always the same sequence. Asset prices deflate, corporate margins shrink, unemployment climbs, and confidence breaks. It's the economy's version of a fever, violent, uncomfortable, but cleansing. Every system that grows too fast eventually needs to burn off its excess. Capitalism is no exception. In our time, this reset could happen in 2 ways. The first, fast and painful, would be a violent repricing of assets when Wall Street loses faith in the very numbers it created. The second, slow and quiet, would be a prolonged stagnation where nominal growth continues but real income keeps eroding under inflation. Either path leads to the same destination, the Great Reset. When it comes, the first thing to be repriced won't be stocks or houses. It will be trust. The belief that every crash will be rescued, that central banks can print away consequences, that asset prices will always recover. These beliefs have sustained the system for decades. But trust is the one currency that can't be printed. Right now, money is still flooding into the same havens, stocks, gold, crypto, as if the party will last forever. Liquidity is abundant, rates are low, and the fear of missing out is stronger than the fear of losing everything. But like every party, when the music stops and the lights turn on, we finally see who's left standing without a shirt. And this time, when the cycle ends, the price will not only be measured in dollars, but in faith. When the crash arrives, governments will respond with familiar words: fair taxation, redistribution, social stability. But beneath those slogans lies a harsher truth. The winners will be asked to return part of the game. Corporate taxes will rise, profits will compress, capital will retreat from risk assets, leverage will unwind, and households, already drained of optimism, will stop investing altogether. The market won't collapse because of a lack of money, but because of a lack of believers. Stocks might recover, assets might climb again, but trust, once broken, never comes back the same. And that is the true nature of every Great Reset. It's not just an economic correction, it's a psychological one. After each collapse, humanity must redefine what value really means. In the last century, America rebuilt from industrial output and labor. In this one, perhaps the world will rebuild on data and energy, the only assets that can't be printed out of thin air. For now, central banks keep printing, politicians keep promising, and the headlines keep cheering new highs. But beneath the surface, the numbers have started to drift apart. And every crisis begins exactly like that, when the math no longer matches reality. Maybe we've simply become addicted to rescue, addicted to the idea that every failure will be bailed out, every panic soothed by another rate cut. But what we forget is that the medicine has become the poison. An economy that survives only on credit and confidence is like a body that lives on adrenaline, powerful for a moment, but permanently exhausted. And when the next real shock hits, whether it's taxes, war, or the collapse of trust, the world will have no choice but to reset. Not with technology, not with money, but with truth. Because financial crises are no longer anomalies. They are the heartbeat of the modern economy. Every crash a breath, every rebound an illusion. But someday, when the world finally stops believing in miracles, the real reset will begin, and no one knows if we'll wake up to a new dawn or another endless night. Act 1. The Crack. A mid-sized bank or fund reveals losses. Officials call it contained. Act 2. Contagion. Investors pull cash everywhere. Short-term lending freezes. Market rates climb even as the Fed cuts. Act 3. Intervention. The Fed slashes rates near zero, restarts QE, guarantees deposits, floods stimulus. Markets rebound briefly. Act 4. The secondary collapse. Reality returns. Stimulus fails to fix fundamentals. Asset prices plunge together. Unemployment surges. Tax revenue collapses. And governments borrow more just to survive. It happened in 2008. It happened in 2020. And if nothing changes, it will happen again in 2026. Only this time, everything is correlated. When stocks fall, bonds fall too. When people rush to gold, higher prices feed inflation. There is no safe haven left. What frightens investors most isn't the crash itself. It's losing the map. Understanding the cycle is that map. Knowing that behind every panic lies a pattern, and behind every pattern, a reset. In the next chapter, we'll dive into the heart of that reset, the whiplash crash, how policy reversals can turn relief into catastrophe, how trust collapses faster than markets, and how to recognize the first tremors before the avalanche hits. June 2026. Headlines start using a new phrase, stress test failure. A handful of regional banks can't meet withdrawal demands from corporate clients. Yields on 10-year treasuries suddenly jump above 6%, something unseen since the 1980s. And that's when markets realize the unthinkable. The Fed has lost control of confidence. This is how the whiplash crash begins. The moment when the cure becomes the poison, the Fed cuts rates to rescue growth. But the very act signals weakness, not strength. Investors around the world panic and flee the dollar. As they dump U.S. bonds, prices collapse and yields spike. Pension funds, insurers, and banks holding trillions in treasuries take massive losses on paper. To raise cash, they sell stocks, real estate, even gold, creating a chain reaction sell-off across every asset class. Credit dries up. Banks pull loans. Small businesses collapse first, followed by the massive commercial real estate sector, where trillions in loans now face refinancing at triple the old rates. Rental income no longer covers payments. Defaults spread through downtown skylines. And for the first time in decades, investors stop believing that the Fed will always save us. They see the trap: a weak dollar, returning inflation, and a central bank stuck between two bad choices: keep cutting and destroy the currency, or raise rates and crush the economy. Every option now leads to pain. Ray Dalio once called this stage the beautiful deleveraging. The system shedding fake wealth to restore balance. But beautiful only describes it on paper. In real life, it means bankruptcies, layoffs, and a level of panic not seen since 2008. Behind closed doors, the Fed knows the only way to stop the bleeding is to shock the system back into belief. On the night of September 14, 2026, the FOMC announces an emergency hike of 1.5 percentage points in a single move. The sharpest increase since Paul Volcker's era. Markets crash. The S&P drops 30% in a month. Crypto evaporates. Gold, after touching 3,200, plunges too as investors liquidate everything for cash. Foreign central banks, desperate for liquidity, sell more U.S. treasuries, pushing yields even higher. The crisis is no longer financial. It's existential. For the first time, the world questions whether the dollar itself can remain the ultimate store of value. America looks like a tightrope walker over an abyss. Each policy step shakes the rope harder. The government issues more debt to fund bailouts, but buyers are scarce. The Fed becomes the buyer of last resort, printing money to buy its own debt. The final loop of monetizing the deficit. Abroad, new trade blocs in Asia and the Middle East accelerate settlement in local currencies. For the first time in half a century, less than half of global trade is invoiced in U.S. dollars. The greenback loses its monopoly, but paradoxically, as trust in all currencies erodes, no one has a safe alternative. The world enters a monetary no man's land, chaotic, unanchored, and brutally deflationary. This is the financial winter of our generation, not just a recession, but a reset of the global order. The cycle turns merciless. It erases the weak, vaporizes the speculative, and preserves only what is real. Production, food, energy, technology. When the smoke clears, the only survivors are those who held cash, owned real assets, and stayed calm while everyone else screamed. Because history always ends the same way. After the whiplash, after the forced rate shock, after the system burns through its illusions, spring eventually returns, but only for those who make it through the winter. When a financial storm hits, everything collapses faster than logic can keep up. A company that took 10 years to build can vanish in 10 days of frozen credit. A lifetime of savings can disappear in 1 month of margin calls. But history shows something extraordinary. The calm few who keep their heads in chaos build the foundations of the next generation's wealth. Economic winter isn't the end. It's a natural reset. It clears bad debt, burns away illusions, and transfers value from the reckless to the prepared. Every dollar printed without substance must eventually be destroyed through real pain. Every company that lived on borrowed time must fall to make room for stronger ones. The cycle doesn't destroy wealth, it relocates it. After the Great Depression of the 1930s, those with cash bought assets for 20 cents on the dollar. After 2008, investors who bought foreclosed homes created empires that still stand today. And in 2026, the survivors, those who keep liquidity, discipline, and perspective, will do the same. The question isn't whether a crisis will come, it's where you'll be standing when it does. Most people will panic. A few will wait, but only a tiny fraction will prepare. Preparation means more than hoarding cash. It means understanding the flow of real money. When the dollar weakens, gold and energy rise. When credit tightens, basic commodities become the true stores of value. When rates snap higher, companies with strong balance sheets become kings. Here are 3 timeless rules for surviving any economic winter. 1. Liquidity is oxygen. Keep 20 to 30% of your portfolio in cash or highly liquid assets. When panic forces others to sell, you'll be the one setting the price. 2. Leverage is your enemy. Debt hides well in boom times, but it multiplies pain in downturns. Pay down variable rate loans, cut unnecessary borrowing, and trade ego for safety. 3. Real value is your weapon. Businesses that provide essentials, food, energy, medicine, logistics, will outlast the noise. Forget hype stocks and miracle coins. Focus on what humanity must keep running even when markets stop. By 2027 and beyond, the system will slowly stabilize. Bad debts will be purged, asset prices will return to reality, and a new foundation will emerge. That will be the dawn of financial spring. Lower rates, renewed demand, and the rise of new industries born from the ashes. The question is, will you still be standing to see it? The most important asset to carry through winter isn't money. It's mindset. The mindset that cycles aren't enemies, but teachers. That crisis doesn't erase wealth. It merely changes its address. And that fear, when understood, becomes opportunity. So if this message makes you pause and rethink how you hold your money, how you invest, or how you see the world, then it's done its job. When you see others celebrating cheap money, remember, that's not the start of prosperity. It's the sound of the storm siren. Because cycles don't care about hope. They just keep turning. The survivors are the ones who know when to stop, when to wait, and when to strike. If you want to go deeper into how to protect your capital, how to track money flow, and how to prepare for the post-2026 world, subscribe to this channel. We'll go through the winter together and meet again in the spring.